Welcome back to Retirement Coffee Talk with Charisse Rivers at Zinnia Wealth. Online, it's zinniawealth.com, or give us a call to sit down and talk about your retirement. Let's do some nuts and bolts. Let's actually put pen to paper here and say, what am I missing? What do I need? And what are you dreaming about? What do you want to do in retirement? Let's try to put the money with it. Give us a call, 833-368-3680. All right, I got an article in Bankrate here that calls the Roth IRA the MVP of retirement savings. So let's talk a little bit about the whole MVP thing. I want an MVP working for me in retirement, Charisse.
Well, most people know MVP is most valuable player. So we could talk a little sports, a little bit of faith, and a little finance here if you wanted to. But let's go back to most valuable player. It's always nice to have one of those on the team. And for Go Gators basketball, Walter Clayton Jr. was one of them, right? So those are, the MVPs are a pretty big deal. I was an MVP for a softball team when I was young, but that's about it. So I understand the feeling. It's a good feeling. And we talked about Tim Tebow earlier. So I'm a big fan and advocate of his Tim Tebow Foundation. And so he actually 2 years ago came out with this t-shirt that said MVP. I went, oh, what is that? And it was so cool. I love it. Most valuable person, right? So part of his autism, Down syndrome group, just everybody counts, every single person. And I just love the story behind that. But now we got to kind of fast forward here and talk about finance. So I came up with most valuable plan, right? Okay. So the most valuable plan is what we would call something that protects your income, grows your wealth, and defends your future when it matters the most, right? So MVPs across the board are all over our world in all different segments of our lives. And we want to make sure that there is an MVP and actually a few MVPs built into your plan. And that means, like you said earlier, tax strategy. That is the right amount of money in the stock market and in the right stocks, the right dividends, right amount of money in annuities if we go down that route, a right amount of money in the 1 and 2 year notes out there, the right amount of money in private equity or real estate. So all these are parts and pieces of the MVP plan here at Zinnia Wealth Management. And you have to have that MVP in your portfolio because earlier we talked about transparency and communication and education is going to keep you confident. So if you don't have a really good drawn out written MVP in your portfolio and in the offices that you work, then you need to start asking for them because how else do you have confidence through times that we just had? And in the future, markets can't stay up forever. We're going to have a crash one day. Yeah. If anybody doesn't think we're going to lose 30 or 40% one day, then
it's going to happen is what you're saying. Yeah, it does happen. That's what markets do, And we just went through the NFL draft and we had 3 full days of all these teams trying to find their next MVP. That's basically what they're doing. And they're looking at these people and they're saying, oh, he's got these skills. He's got these things about him that I think that we need to plug in to our system that's going to work and make our system work better. In a way, Charisse, when you choose a financial advisor in your life, you're looking for your next MVP. You're looking for your next most valuable player. And I think that knowing how that person reacts during times like this, if the market's going up like a hockey stick, every financial advisor looks good, but it's times like this that you really see who the MVP is, don't you?
Exactly. And it's just a built-in written plan, a built-in strategy, a non-just basic 60-40 portfolio. You can sprinkle in a 60-40, but you're going to sprinkle in other asset classes from 5 to 6 different legs in your portfolio. If you don't have 5 to 6 things built into your portfolio and you just have a 60-40 portfolio, yeah, you could survive it, but it depends how much money you're going to live on. It depends on how much emotion you can handle and not pull the trigger when you're being emotional. There's so many things that you have to dial into when it comes to that asset allocation, the bucket strategy, the income strategy, the wealth preservation strategy. And you want to make sure that you understand the plan.
Well, there's a lot of different financial products out there that you can use in your retirement. You need to see all of them in front of you to see what's right for you. Now, this article from Bankrate says that the Roth IRA is the MVP of retirement savings. They say they love the after-tax contributions. Right. They love the tax-free withdrawals. However, the Roth does have a certain amount of limitations. There are limits on how much you can contribute. There are limits because your money has to sit for 5 years before you can access it. So there are some limitations, some downside. How do you take these limits that are within that Roth IRA and make them that retirement MVP?
You know, it's tough, but there are some strategies. There's always the backdoor Roth, because if there are limits based on how much income you pull in every year, you can't contribute to a Roth at all. But there is a Roth backdoor strategy that you can do if your income's over a certain amount of money. But you're still limited. Here's this number 2 limitation to how much you can put into that Roth. And it's based on W-2 wages. So if you're over 50, you can, do $8,000. If you're under 50, you're basically at $7,000. So you're limited. You're like, well, how do I get that to $1 million? Well, it's nearly impossible, right?
At that rate, limit. Yeah.
So the catch is this is the other workaround. You could start rolling your IRAs over to a Roth. And even if you're still working, you can do that, by the way. As long as it's a transfer or rollover form, you can transfer IRAs to Roth with 0 penalties. Of course, anytime you put money into a Roth, it's coming from your bank account on average. And so you already paid the taxes on that. But if you're rolling it from an IRA to a Roth, you do have to pay the taxes on the rollover, of course. But trust me, taxes are, a big bang effect.
Yeah.
A ticking time bomb when you retire. And the myth is, you're going to be in a lower tax bracket. I meet very few people that are in a lower tax bracket because of these IRAs that have blossomed so much. So you want to have tax-free income in the future as taxes go up. So that's one of our goals. You want to leave a tax-free inheritance to your heirs so that they're not held with this big tax debt. And, 30 to 40% of your money could possibly just go back to Uncle Sam. So pay it now, especially if you're only in a 15% or 20% or 12% tax bracket. That means more money to your heirs in the future, which grows tax-free. So there's so many things that you could do, but you might be able to do all of them. You might only be able to do one, depending on your age, depending on your income, depending on how much extra cash flow you have. So this is why it's good to work with a financial advisor, because maybe one year you're like, nah, I can't do this year, but hey, maybe this year we can make a plan. And then you can, I call it leapfrogging, change up strategies every 2 years so that you can start building that tax-free bucket.
So one of the things that you have said in the past, I'm reaching back into my mental checklist of things Charisse has told me, and that is this. You said to me that if you have a Roth IRA, that money probably could have a little more risk to it because that might be the last bucket that we access.
Yes, we tap into. So just know when you have a Roth IRA, to get all the interest that it grows, tax-free, you have to be 59 and a half and older, and you have to have it for 5 years. So that's the other thing. But so mitts off, basically, when it comes to your Roth when you're first starting it. But most people won't tap into a Roth till later on. Okay. So that if you don't need these dollars till later on, I'm talking about 10, 15 years, 20 years down the road, then you can have all the risk you want, because we always know the stock market comes back. So that financial conventional wisdom, buy and hold, works best in that Roth IRA, believe it or not.
So does that change the philosophy any if you take it out of your 401k and move it over to a Roth? Should there be a different mindset as far as risk is concerned?
Absolutely. A lot of people, when they come in and we do their portfolio x-ray, we notice the Roths are really the most conservative thing out there.
Wow.
Yeah, they're sitting in banks and cash. And what they don't understand is, because nobody's educated them, is like those are the dollars that will never be a ticking time bomb. They will never be taxed again. So those are the dollars we want to double, triple, and quadruple. And those IRAs, we want them to be more conservative, because I don't want that thing to double, triple, and quadruple, because that means so much more money out of your pocket to Uncle Sam. It's a wasteful spend, in my opinion. And we'll do the math when you come in, because I know people are like, what is she talking about? Why wouldn't I want my 401k and IRA to double, triple, and quadruple? I'll show you the tax burden on the horizon if your accounts do grow that largely in comparison to the Roth strategy.
So that Roth IRA could be the MVP of your retirement portfolio. And in order to figure out how to do that, and I mean, passing the money on to your heirs and doing that without the big tax bill for your spouse or your kids, it really does make a lot of sense, at least to talk through it, doesn't it?
It really does. And there's a lot of MVPs in our portfolios, and it comes with sprinkling in that Roth strategy. It also comes with your estate plan, making sure your wills and trusts whether it's a dynasty trust or an irrevocable trust or an income trust, whatever it might be, depending on the season and stage that you're in, is also a part of your MVP. The long-term care plan, that's a whole segment of your MVP, right? The income plan, like what are we living on for the next 30 years? How are we going to maintain our principal? So the strategy built inside of that portfolio is going to be part of the MVP of the overall written comprehensive plan. So there's a lot of MVPs that we have to work on, and those people who are just keying in, most valuable plan, MVP. So
give us a call at Zinnia Wealth and let's sit down and build that MVP retirement plan for you, choosing the right options, the right financial vehicles, the right risk level, having a good tax plan. It's all a part of what we do at Zinnia Wealth. Give us a call. Give us a look on our website, which is zinniawealth.com, ZINNIA wealth.com. You're going to see a gold box there. It says complimentary retirement consultation. Click on that. We're going to ask you some information and just put in, some little contact information there, and our team will reach out to you and start the conversation. Let's see if we can help. You can also call us 833-368-3680. Again, 833-368-3680.
Thanks for listening to the Retirement Coffee Talk podcast. If you have questions or would like to begin the process of building a tailored retirement plan, call Zinnia Wealth at 833-368-3680 or find us online at zinniawealth.com.
Investment advisory services offered through Zinnia Wealth Advisory, LLC, a registered investment advisor. The firm only conducts business in states where it is properly registered or is excluded from registration requirements. Registration is not an endorsement of the firm by securities regulators and does not mean the advisor has achieved a specific level of skill or ability. Insurance products are offered through Zinnia Wealth Management, LLC, Florida license L078655, and Charisse Rivers, Florida license P037744. Zinnia Wealth Advisory, LLC, and Zinnia Wealth Management, LLC are affiliated entities. The information presented is believed to be current. It should not be viewed as personalized investment advice. All expressions of opinion reflect the judgment of the presenter on the date of the podcast and are subject to change. The information presented is not an offer to buy or sell or a solicitation of any offer to buy or sell any of the securities discussed. You should consult with a professional advisor before implementing any of the strategies discussed. Any legal or tax information provided in this podcast is general in nature. Always consult an attorney or tax professional regarding your specific legal or tax situation. Any client experience discussed on this show are unique to that client. Annuity and life insurance guarantees are subject to the claims paying ability of the issuing insurance company. If you withdraw money from or surrender your contract within a certain time after investing, the insurance company may assess a surrender charge. Withdrawals may be subject to tax penalties and income taxes. Persons selling annuities or other insurance products receive compensation for these transactions. These commissions are separate and distinct from fees charged for advisory services. Insurance products also contain additional fees and expenses. Social Security rules and regulations are subject to change at any time. Always consult with your local Social Security office before acting upon any information provided herein. References to specific investments should not be construed as being past specific recommendations. The returns for various indices discussed in this podcast do not represent the performance of the firm or any of its advisory clients. Returns do not reflect the impact that advisory fees will have on an investment. Past performance may not be indicative of future results. All investment strategies have potential for profit or loss. Different types of investments involve higher and lower levels of risk. There is no guarantee that a specific investment strategy will be suitable or profitable for an investor's portfolio. Historical performance returns for investment indexes and or categories usually do not deduct transaction and or custodial charges or advisory fees, which would decrease historical performance results. There are no guarantees that a portfolio will match or outperform a specific benchmark. Investments in fixed income products are subject to liquidity risk, market risk, index rate risk, credit risk, inflation risk, purchasing power risk, and taxation risk. Because bond prices fluctuate continually, their yields change constantly.